Hello, I'm Neil Scruton, owner of Scruton's Limited Chartered Accountants. We're now into the second year of the new dividend taxation regime, so I thought it was worth talking about that because it's something that will affect most shareholders of limited companies. For the 17-18 tax year, which has just finished, the tax-free allowance for dividends is still £5,000 per person, but the 18-19 tax year that we are now in, that will be reduced down to £2,000 tax-free. Any basic rate dividends are going to be taxed at 7.5%, high rate dividends 32.5%. So there are a couple of ways that you might want to look at reducing the tax on dividends. Firstly, if you have a spouse, then obviously you can transfer some shares to your spouse to make use of their tax-free dividend allowance, and if they are a basic rate taxpayer, you may be able to have some dividends at 7.5% as opposed to 32.5%. That's worth considering. With a spouse transfer, there is no capital gains tax on the transfer, so worth considering. The other thing is some people are looking at making pension contributions rather than paying dividends. So your company pays a pension contribution on your behalf for which it gets tax relief and on which you are not taxed, and then that reduces the amount of dividends taken. Bear in mind obviously that a pension contribution will be tied up, you'll not be able to get your hands on it until you are 55 usually, so it's more of a long-term plan, but certainly worth considering. Increased salary, still not necessarily very tax efficient because that is subject to national insurance, so you will pay more tax overall anyway. So that's a bit of a rundown anyway. If you have any questions, obviously give us a call 01827 715 264 or go to the website www.scrutons.co.uk, email us at info@scrutons.co.uk. Thank you.